Hey, I'm here with George Lane with Guild Mortgage, a local lender that's been in the business for 30 years. And George, how did you get in the business and what do you love about it?
Yeah, so how I got in the business, I'll do that as a quick one. So a bunch of years back, I was working for this paper and packaging company in sales, and I woke up one day and realized I cannot stand what I'm doing. I like talking to people, I like doing all, but I can't stand what I'm doing. And I didn't like the products, and then I met with a friend of mine who was in the mortgage business. She said, "You got to come over, you got to do this," and I switched over and been doing it ever since.
And
So
was that with Guild?
no, no, no. This is a long time ago in California. A company called First Franklin.
Okay.
They don't exist anymore, but
Okay.
yeah. So, but it was, it helped me with a couple things. One, it's the finance side. I love the numbers, absolutely love the numbers. But it's a people game. I mean, it's always just about who you're connecting with, but who you're able to help, and that's the part I love about this. I love educating people, and I love helping people, and not just helping them from the standpoint of just being a nice guy. It's really helping them to make decisions that are going to have a long-term impact in their life, and making good decisions, making decisions that are going to help them get into a better place. Because
Mhm.
as you well know, with real estate, not only is it your home, but it's a wealth builder. And it's kind of a fun thing to work with people and help them make those steps that get them where they want to be.
Right.
Yeah.
Yeah. And I should also say that you are also the loan officer on my mortgage loan
Yes,
on my
that's
home.
right. I am.
I'm going to purchase a home
Okay.
and I'm looking to get pre-approved.
Mhm.
What does that process look like?
Yeah, great question. So there's three levels that we look at. There's pre-qualification, there's pre-approval, and then there's credit approval or full approval. Okay. Pre-qualification means you've done an application with us, we've pulled your credit, you've told us what your job is and what your monthly income is, and we've said, okay, everything looks good. Pre-approval means we've taken the next step and we've actually gotten pay stubs and W-2s, or if you're self-employed, tax returns. We've gotten bank statements so we know you've got the money available for closing, and that's pre-approval. And kind of the corollary to that is, why do we worry about pre-approval? Well, pre-approval from a standpoint of a real estate transaction, even though it's not the rule that you get pre-approved, the industry norm is you get pre-approved or your offer doesn't get accepted. So
Hmm.
that pre-approval is super important. But it's, Carl, we can do that as fast. Well, I've done it on a Sunday with an application in at 9 a.m. and I had them making an offer at 11 a.m. I mean, it can happen
Wow.
really, really fast. Or the client may just say, I'm just going to kind of go through this slowly, and that's fine too. But we can do it really fast. Or typically, I'd say it probably takes 24 to 48 hours for that pre-approval. Yeah.
And so, like, if you're going to be seen as a serious buyer, you would want to get
Right.
pre-approved.
Yeah.
Yeah.
Well, I think of it on your side as a listing agent. Would you take an offer from someone who wasn't pre-approved?
No.
No, you just wouldn't. That's our industry norm. There's not a rule that says you have to be pre-approved, but the norm is that's what you do.
Right.
Yeah.
Did you say there was a third thing?
Well, there's credit approval. So we got the pre-approval, which means you can make an offer and we can write a letter. Credit approval would mean we actually take you through the underwriting process. And in years past, that underwriting process was done once you were in contract. Okay, we've been doing that credit approval process a lot more lately because it's helping in a competitive situation.
Mm.
So if you've got, just again, think of it from a listing agent side. If you're representing the seller and you've got three offers coming in and they're all pretty equal, but one of them's already through underwriting, that's really attractive, right?
Right.
There's a lot less mystery associated with that. We know what the conditions are and we're able to move faster. So that credit approval could be a really nice step. It's not super necessary, but it's helpful.
In a multiple offer
It's
situation,
a really
perhaps.
good way to go. Yeah.
So if you're fully underwritten, that is the credit approval.
Correct.
Okay.
That's credit approval. And without getting too technical here, when we say you're pre-approved, what that means is we have all the application information and we've run that loan through the automated underwriting system. So I think of it like a little black box. We've got all this information here, we put it through the little black box, and out this end comes an approval with a list of conditions. We need 2 months 2 months bank statements. We need the most recent two pay stubs. We need last 2 years W-2s, that sort of thing. We get those conditions. So from an underwriting standpoint, then when you take that through that credit approval process, the underwriter says, okay, we've got this approval findings, these automatic findings. They're then going through and validating, okay, yep, that checks, that checks, that checks. So like, okay, great, this is all set. All we need are these other three things.
Mm.
So that's just again, you're that much farther along in the process. And
Right.
it can help a lot too in terms of just being able to close faster
Right.
because really all we need to do is get an appraisal
Right.
from that point. So,
Interest rates are a little higher than they were last year.
yes.
So let's say I'm a buyer and I'm interested in a rate buy down. What
Mhm.
what does that look like?
Sure. Okay, so rate buy downs right now are super common. And to take you back a little bit, so last year, March 1st, we were looking at rates that were still pretty darn low, but we knew there was this looming thing of the Fed raising interest rates. Well, they started last March and they've done it. So we've seen rates just do this all last year. What happened is up until probably like April last year, we pretty much had a normal interest rate where you could have rebate, par, and discount fee, right? So rebate means you could get a little bit of money to help cover your closing costs. Par means didn't get anything, doesn't cost you anything. Discount, which is the far more common way, meaning you're paying some money to get it to a lower rate, okay? Well, starting last April, that upper part, the rebate, got a lot more difficult.
Hmm.
So discount fees have been the norm for the last 10 months, okay? So what that means is you're paying some money to buy your rate lower, okay? Now, the other way you can look at that is a temporary buy down, okay? So temporary buy down, the typical one we see is what's called a 2-1 buy down. And that means you're gonna buy your interest rate down 2% for the first year, then it'll go up 1% for the second year, and then the third year beyond, it's gonna be at that initial, that regular note rate. So the advantage of doing that is you're going to get this super low rate, super low payment for the first year and save a whole bunch of money. That second year, you're still going to have a much lower payment, and then you're at that level for the rest of the way. That savings in the first 2 years is a big deal for people. And that's
Mhm.
where we've seen a lot of people going, oh, yeah, that's going to help me. And either they're taking that savings and just kind of socking it away for the year 3 and beyond, or it's just helped them in a situation. Let's say, for example, we've got someone who knows they're going to be up for a raise in a year. And so that payment, that third year and beyond, is going to be a piece of cake once they get that raise.
Right.
But those first 2 years, that's going to help them a bunch while they're bridging that time period. So it can be really helpful for people in that respect. And other people are just going to say, hey, I'm going to take advantage of this. At that lower payment for the first 2 years, why wouldn't I do it? So just as an example, 400,000. Let's say your loan amount's 400,000, and you're doing the 2-1 buy down. You're probably saving roughly $10,000 per month over those. No, excuse me, 10,000 total,
That's
total
a high mortgage payment.
over those 2 years. So but $10,000 in 2 years.
That's
It's a
huge.
big deal.
Yeah.
It's a big deal. So those temporary buy downs have been super attractive. We didn't see one of those before May of last year. They just hadn't been done in years and years.
Mm.
And they were very common, and still we're seeing them still this year. So what we're looking at there with the buy downs is, does that 2-1 buy down make sense compared to the permanent rate buy down? And the way I look at that is, um, if you think that at the end of 2 years, there's a chance that the permanent rates are going to be lower anyway, so we're going to be able to refinance you,
Mm.
the 2-1 buy down is a great way to go.
Right.
Save a whole bunch of money in the first 2 years and then refinance into a permanently lower rate, and away you go. So that's been, I don't want to call it a gamble as much as it's just kind of, but you're taking a little bit of a chance that, hey, I'm going to get this great payment for the first 2 years
Right.
and then get into a lower rate and be really, really cruising from there. Versus the permanent rate buy down, you just know, okay, I'm set here. I don't care what happens with rates. I know I'm in a good spot here for the next 30 years if that's the case.
Right. And so with the permanent, it doesn't go as low
No,
as the
no.
2-for-1 or the 3-2-1 or
Yeah, the permanent, in that same, if we were thinking about that same scenario and the cost of that 2-1 buy down, you're probably talking about 5/8 lower, so
Mhm.
0.625% lower in rate than the standard. So it's nowhere near as sexy as the 2-1 buy down, but it's a great deal for a longer period of time.
Right.
So if you were looking at both of them over 2 years, the 2-1 buy down definitely saves you more money, but over 4+ years, the permanent rate buy down saves you a lot more money.
Right.
So
It seems like that would really make sense for a majority of homeowners that are or home buyers that have an occupation where they're earning like a W-2, and
right,
then so generally their income will increase the
right,
longer that they've been with the company.
yes,
So, but like let's play devil's advocate
hmm
here and say that someone that went in a 2-for-1 buy down or 2-1 buy down,
Right.
they you know, lose their job, or you know, they have to
Right.
cut their hours. Do they have any options at that point of when the interest rate does go up?
Well, it is absolutely set. That first year, for the first 12 months, you get that 2% lower rate, and then the next 12 months. So after 24 months, you're going back up to that standard rate. So let's just take an example. Let's say the standard rate would be 7% right now.
Hmm.
So the first year you're going to be at 5%, second year you're going to be at 6%, and then 7% from there on out. But as I mentioned, so if it's $10,000 over those 2 years, that first year payment is probably lower by about $500 a month,
Yeah.
roughly, and then it goes to about 250. So it's a significant difference in payment that first year. So if the person's really excited about that first year payment, but not very excited about that year 3 payment, to the point where it's really, really going to make them lose sleep, then I wouldn't do that. I would
Right.
just go with the permanent rate buy
Yeah.
down and do it that way. And I've had some clients who they get it, they see the 2-1 buy down, and they understand why someone would do it, but for them it just doesn't work. It's too much of a risk
Right.
of what they'd be at. So they'd rather do the permanent buy down and get themselves into that lower spot and know it's there, know
Right.
it's set.
Right.